Hello, hello, everyone. Episode 6 of the Capital Spotlight podcast with the one and only,
Rob Beardsley, pleasure to be here.
your host, of course, Craig Mcgrouther. We're excited to do another episode here right now. And we actually have a ton to speak on, which we're really excited about. First things first, where are we coming from right now? You are in,
I'm back at HQ here in our New York office.
right? And then I'm, of course, in Lone Star West at the satellite Scottsdale office here in Arizona, melting away in the streak of 110 plus degree heat. I'm starting to lose my mind a little bit, but it's all good. I'll be going to visit family for actually service for my grandpa coming up next week, and then I'll be in Oregon to hang out with them, and then back to possibly Dallas again to meet with a big client, if I'm not mistaken. So good stuff there.
Very good. Yeah.
Awesome. Well, and you were just in Dallas, is that correct?
Yeah. So our acquisitions analyst, Brad and I, we were just in Dallas and Houston for the entire week last week. We were doing a little bit of a broker tour. We were meeting with a bunch of brokers to talk shop, to talk deals, talk market. So we're fresh with a lot of market intel and always looking at new opportunities. But yeah, it was an interesting trip to say the least.
Right. And if I'm not mistaken, you go to a place like Dallas, you go to a place like Houston. These are some areas in America are more relationship based, and some places talk a little bit more. Some places talk a little bit less. But to my knowledge, Dallas and Houston are two of the more relationship based cities. And there's kind of a lot of, or can be a lot of, I should say, broker gossip and talk. And when you were there, if I'm not mistaken, there was a lot of hot takes and interesting conversations and stories that you heard. Do you want to kind of dive into some of the things that were discussed and kind of the general theme? This might be really kind of interesting to hear if you're an investor, if you're a syndicator, or anywhere in there that's just intrigued in the market. Break down kind of what you were hearing, what you and Brad were kind of taking in.
Yeah, so it's interesting to talk to brokers, in both those markets at all the different shops and hear somewhat of a spectrum of feelings towards the market and prognostication about the future. And it kind of ranges from doom and gloom to maybe slightly positive, right? And so everyone's kind of seeing the same things, talking the same things. It's just a matter of how honest or how optimistic or pessimistic they are, right? And so that's just number one interesting to see, because some people are saying, yeah, we're seeing cracks in the system right now, and we think in a year from now there's going to be foreclosures and there's going to be short sales and discounts and exciting activity like that. Other brokers believe that pricing will stay pretty resilient and people will be able to manage through, and everyone has their own interesting ideas. So one interesting point that we heard, which I agree with, is lenders are going to be willing to work with their borrowers through the next couple years. So even if you have a bridge loan that's maturing at some point, the lender isn't going to just the day of maturity go, all right, well, this loan was matured. You don't qualify for an extension. And so that's it. Your maturity defaulted and we're going to proceed with foreclosure. Right. That's not going to happen. These lenders aren't set up to have asset management teams and to foreclose and own these properties. So they don't want to own these properties, right? They want to work with a borrower and keep that asset going, keep that relationship going. And so that's one thing. So for everyone thinking, oh, well, once these loans start maturing, that's it. We're going to have a wave of foreclosures. I don't think that's true. The other point about that is a lender is going to be less excited to foreclose on an asset if their loan amount is today's value, which is what a lot of brokers were talking about, is that, hey, the reality is some of these over levered deals are worth less than what the loan balance is. As a lender, you're not going to be very excited to take over a $20 million deal if your loan on it is $20 million, right? You don't really want to own for par, right? Now, if I'm a lender and I have a chance to foreclose on a deal, a $20 million deal, and the loan amount is 10 million, well, that's fantastic. I can foreclose and now I own the deal for half of what it's worth. So I can kind of manage it, tune it up, and then sell it and make a profit. So, but when we have these situations where the deal's over levered, the lender isn't going to make any money. The lender's probably going to lose money by foreclosing and selling. They might as well just keep the loan in place, keep the borrower in place, and continue to earn interest, right? That's a better way to manage it through. It's kind of like having an outsourced asset manager as a lender, right? The borrower is working for free. The borrower's lost all their equity. They're not going to make any money on the deal, but you get to still get their management and a care to the deal because they signed on the loan, and that's their reputation. That's their credit worthiness.
Very interesting. So kind of what you're saying then, it was one of the takeaways is that lenders don't actually want to take the deal. They don't actually want to take the asset, correct?
In most circumstances, yes.
Right. Are there maybe historically some other lenders, some shops and banks that do actually want to take them and are, chomping at the bits to do so? Or is that more of just kind of maybe a fallacy?
I think those lenders do exist, but I think loan to own type shops, I think that is not as common as people think, right? They're brought up, but I don't think it's as common. So that's not a concern. I would say that some lenders are more ready and willing to foreclose. They lend the money out and they say, hey, if the deal works out, great. If it doesn't, we're going to be comfortable taking the deal back. So that does exist. And that's why relationships are so important, regardless whether you're talking about brokers, investors, lenders, right? Because inevitably there are going to be hard times, and relationships really are worth their weight in gold when you do run into hard times.
Interesting. So with that said, we have a couple ends of the spectrum. There are a couple things to unpack. So we've got some deals that we don't think are going to be taken, and then some deals will. What would be the circumstance where people just put their hands up and just say, take the property? Because I feel as if there's some people are going to feel that defeated in this market and so struggle that they just might, put their tail between the legs and go home. And then there's going to be some groups are just too fiery and have too much pride that won't let that happen. So what kind of defines a deal where people would be willing to walk away from it and something that you think people would want to fight for?
Great point. So we're noticing that in the market and having those types of conversations because there are some groups today that are willing to sell and get out ahead of potential further issues, right? So maybe instead of making a capital call and maybe making another capital call and survive to 25 and try to just extend and pretend with their lender, they're going, hey, we made a bad investment. We're just going to sell now and we'll take our losses, right? And so the groups that are doing that right now, there's not that many of them, but the groups that are doing that right now are the big groups because they've bought 50 deals, they've exited a bunch, they have a good track record, they can afford.
Full cycle. Yeah,
they've gone a bunch full cycle, they've made a ton of money for their investors. They can afford to have one bad deal or a couple bad deals in their track record that's not going to kill them, right? So the groups like that are willing to take a loss now and just move on with their lives, right? A group that's younger and doesn't have as robust of a track record can't afford to do that. So those are the groups that are going to be fighting tooth and nail to do everything they can to keep their deals and get their deals on the right path, right? So that's the dichotomy that we're seeing in the market. Bigger groups, we won't name any names on this show, but bigger groups are experiencing pain and smaller groups are experiencing pain. But
and the market's experiencing pain, right? Yeah.
But the bigger groups are the ones that are more capable and willing to cut bait on a deal that's not going well.
Absolutely. And then I actually have an interesting thought on this as to who would be okay with it and who would not. I would imagine that folks who have more kind of friends and family and more of their own kind of private network capital and deals would be the groups that would fight a lot harder versus maybe a bigger syndicator that is more of a REIT-like style, big, hey, we're just going to move on and we're just going to kind of dump this property and get what we get. Would you say that's a fair assessment that more institutional equity might be more willing to walk away from it as opposed to losing your best friends and, your cousins, $50,000 that they're putting into their first syndication just at a point of pride?
Yeah, exactly. It's similar to the same concept of the track record. The institutional money has the track record. They have the wherewithal. They'll be around tomorrow if they have a bad deal, right? It's not going to crush them in reputationally or financially. The other point that I wanted to make about institutional groups is if they're structured as, like you said, a REIT or in a fund vehicle, then that deal that's doing poorly is not a standalone deal. So if they have a fund and that fund overall did well and the one bad deal, it'll bring the average returns of the fund down, but it's not, the fund's going to survive, right? So it's easier
But
also to take a loss in a fund.
it's also, I would imagine, likely within their margin of error as to where they can kind of fall in there. If there's, a bunch of deals that are 20, 30 IRRs or whatever, and then you've got one that's maybe minus, a couple points, or, you break even on the deal, it's easier to stomach that because the net average, to your point, will still look really good.
Right. Exactly. So yeah, so that's an interesting thing that we're observing in the market. The thing is, though, when we were looking at some of these deals, touring some of these deals, that basically the seller wants to get out and they're willing to take a loss and lose potentially most of their equity, it's still not a good deal for us, right? And maybe we're making a mistake, maybe not, but we're not getting to their number. So it's amazing to see the gap that someone who overpaid, overlevered, and now they're selling at a loss and they're going to lose half or all their money, let's say, that still is not a big enough loss for them to take to be a good deal for a new buyer to come in, at least one that's seeing the world in the way we are and being more conservative.
And that's interesting because that's just fully to the premise that the market still has not digested entirely the interest rate environment that we're in right now. And that lag is still slowly but surely happening. And, unlike the stock market that, fluctuates and can go up, down, left, right, real estate, for the beauty, for the better or worse, is the slow trading asset class that has maybe 6 months, but likely a year to delay this process. I mean, that coupled with not a lot of property selling right now, kind of creates an environment where there is kind of still kind of a forced level of value there that maybe we can't make sense of, or at least don't want to take on the risk in this, particular market, which is interesting. So on those properties that you mentioned that the sellers are want to, or be more willing to just kind of take the loss on it, are these newer assets? Are these 2000s newer? Are these 60s? Are these 70s? Is this junk? Or is this like quality product that it just didn't work out due to market timing or their capital structure, or, whatever it may be, the debt profile associated with the deal? What were you seeing where that was there? And what are you seeing people are, more stubborn to let go or aren't even thinking about trading?
I would say the newer stuff is more resilient. So you're going to see less distress with the newer stuff. There's just more bidders there, and there's going to be less operational distress at that level as well. Is what the consensus is. You never know what's actually going to happen, but the consensus is that junkier property, when we say junk, I mean we say it endearingly, we love to own junk. There's plenty of money to be made in owning junk, but junk would be defined as, like 1970s vintage properties, lower income, not the prettiest properties, right? So there's money to be made there, but there's also more risk. You have operational risk because you're dealing with lower quality tenants that are more susceptible to job loss in a recession, generally speaking. And you also are taking physical risk, which is the real estate's older and it's more likely to have deferred maintenance and cost you more to run. So right now, the people that are quote unquote fire selling, if you will, I would say are more so in the older stuff because they realize that they overpaid and that there's going to be trouble ahead and they might as well just get out now. And also Dallas and Houston are different markets. And that was something really interesting that we heard on our little trip, is that prices are for sure down more in Houston than they are in Dallas. There's more bidding activity going on in Dallas than in Houston. So Dallas is humming along relatively well. They're still conducting best and final processes, which for those that aren't familiar with broker deals is best and final processes where you first have a call for offers, the buyers come in with their bids, and then the broker and the seller select the best bidders of the bunch and invite them to a best and final bidding round. And that's where they submit a buyer questionnaire, fill out some information, come out and tour the property if they haven't already, and submit a best and final bid. So Dallas is still having a competitive enough environment to be able to facilitate something like that. But in Houston, there's very few best and finals happening at all because there's just not enough bidders really to go in there and conduct such a process. It's more like, hey, the seller wants this number. If you can get to this number, we can make a deal. And then the deal's just kind of sitting there.
I was actually going to ask you next what was kind of the buzz between the two different cities. And for everyone who knows this or knows Lone Star, knows that we are primarily and only focused in Houston and Dallas. We may actually expand to a third market, but we won't talk about that right now. But just kind of the word on the street and the buzz regarding Dallas and Houston. So you kind of mentioned it that Houston is a little bit more, yeah, bring your offer. It's waiting. The water's warm. And then Dallas is still that, yeah, but we have multiple offers. So if you don't work out, someone else will, which is crazy to think about. But it does make sense. And Houston obviously has some issues associated. So I guess maybe give me the dialogue between brokers and kind of the tonality and just the overall feeling that you got in Houston compared to Dallas. Because I think it's a really interesting thing because two submarkets that are really solid, that are about 4 hours apart via drive, but that had a totally different feeling. So can you walk us through what that was like?
Yeah, for sure. The reality today, at least, is for nicer Class A, I would say 2010 to new product in Dallas. Like I said, there's plenty of bidding. There's been a price adjustment, but it's strong pricing still. Deals are still trading in the low 4% cap rates. That's extremely expensive considering that interest rates are in the 5s, right? Depending on how you're financing and your structure, it could be low 5s, could be high 5s. That's kind of where rates are. So, which kind of makes sense because just historically speaking, if you're going to buy in a quality market, not a quality market, one of the best markets in the country, Dallas, if you're going to buy in a premier market and you're going to buy premier product, that means usually you're going to finance at about a 1% negative interest, negative spread, right? Or negative leverage.
Leverage, yeah.
Yeah. So it's funny because people, like we've discussed on this show, people have been kind of harping on, oh, well, if the deal doesn't have positive leverage, it's a bad deal and I'm out. Well, the reality is good real estate's almost historically always been purchased at negative leverage. And so while it does feel a bit offensive that Class A deals are trading low 4s and you might have to finance that at 5.5, 5.75, that's the reality of the game. That's just competitive, right? Everyone wants to own that asset. So you're seeing a strong market for high-end Dallas stuff. In Houston, that to my knowledge doesn't really exist. We toured some very nice properties in Houston that were going for some pretty strong discounts, where we're talking Class A assets that are going to trade somewhere in the low 5s.
That's incredible. We're getting, so would maybe if a Class A, which is, typically speaking, for those who don't understand the kind of terminology of that's typically speaking, probably 2000s build or newer with a really solid tenant profile. And then B would be perhaps 90s or 80s, maybe partially remodeled, partially redone, with, more of a workforce feeling to it. Class A can still have some workforce feel to it, but also a lot of white collar esque, finance jobs, whatever it may be. And then C is, hard workforce, low income, and well, below that is below that. You can do the math on that. That's, probably, government and vouchers and housing of that nature. But very interesting that Class A is almost trading at that 5.1-ish range. What would you say Class B is at from a cap perspective? Are we running into positive leverage where it'd be about 5.5 to 6 almost on things of that nature, call it 90s and 80s?
Yeah, not quite. That's kind of where value is trending. But just because something is quote unquote worth that doesn't mean there's a seller ready to sell at that price. And that's the whole reason, like you mentioned, why real estate's a slow moving beast, because sellers don't adjust their expectations overnight. Sellers are clinging to yesterday's price. They have many reasons to do so, right? They don't want to just accept the loss right now and move on, most of them. So even if their deal is getting a BOV or a broker opinion of value at, let's say, a 5.5 cap, the seller or the owner of that property could say, well, I just can't get out at that price. I just don't want to sell for that price. So I'll just hang on instead. And that's the beauty of real estate, right? Because just because prices are down today, nobody's saying you have to sell for a loss today if that's your reality. You're more than welcome to, if you have the capital structure, and the wherewithal and the patience to hold, you're more than welcome to hold. Continue to cash flow. If you have cash flow, if you fixed your debt or something like that, then you might still have very good cash flow right now. There might be no reason to sell, and give it 3 years and you'll be able to sell at a profit then. So while right now it's good and bad, right? There's going to be good opportunities to buy, I think, but then also deals that were bought before might run into issues. So, you have one thing to manage and one opportunity to chase after.
Interesting. So do you think one market has had better success compared to two of tenant success, i.e., hitting the payments, making sure that rents are coming in, collections, things of that nature? Did you get any breakdown or difference or nuance between Dallas and Houston as it pertains to that subject and that piece, or is it pretty similar?
I think it's pretty similar. We're not seeing a big divergence in performance. That's the thing. Performance remains strong. Everyone's pretty optimistic about performance, right? All these conversations we're having, nobody's saying, oh, it's doom and gloom. I think we're going to have a big recession and we're going to see rents go down or occupancy go down or collections go down, right? Nobody's really saying that. Everyone thinks pretty positively. And also people are pretty happy about the supply pipeline in most places, right?
Well, that's going to get totally probably slowed down. I mean, obviously, when recessions happen, builders stop building, new houses stop being built, units and ground up starts going away, which is incredible for the people who are like us, who are in the workforce anyways. But even if you're a kind of a class A person that just brought their property to market, great. You might not have a bunch of new units coming to compete with you right away, which is awesome. So that is beneficial if you're owning and buying kind of in that world, which is very beneficial. A question I had for you is what percent, and this is kind of to the point before about needing to sell, not to sell, what percent of people do you think took advantage of the incredible debt when rates were lower, call it 16 months ago, call it from 36 to 16 months ago, that locked in long-term agency debt where they put 5, 7, or likely 7 to 10-year agency on it? What percentage of groups do you think did that? And do you think they're laughing at everyone who took out the shorter debt right now?
Oh, they're for sure laughing. They're laughing all the way to the bank. They're sleeping well at night. Unfortunately, I don't think that many people did. I think if I were just to throw a guess, I would say maybe 20% of the groups out there maybe did that. The reason why is because it was so difficult to size. We went into such negative leverage territory that you would get 40% leverage going agency. So yes, you could get a fixed rate loan, a long-term fixed rate loan, but those loans are based on in-place income. And because cap rates got so compressed, right? We were talking about in Phoenix, people were talking about cap rates in the 2s, right? We're talking about 2s in Phoenix, 3s in Dallas, and 4s in Houston, and even some high 3s in Houston. So with such negative leverage, there was just not lenders that lent on a fixed rate permanent basis didn't have the ability to size to 70% LTV, 80% LTV. But bridge lenders could. So bridge lenders, mostly with floating rate products, were able to in that moment step in and provide high leverage, and in some cases too high of leverage, while the agencies could not. So that's why it was such a low percentage of people, right? Looking back on it, it's like, oh my gosh, that would have been such a no-brainer to lock a rate. But the reality is, would you have wanted to buy that deal with 40% leverage? No, you wanted to buy with 80% leverage, right?
Absolutely. And I think just the tale as old as time, when markets get really hot and the light is burning brightest at the end of kind of the run and cycle, and everyone gets high on interest rates, we all get greedy. We're all looking at our competition, looking at what the IRRs are kind of shaking out, and how we maximize that and be competitive with our partners. And this is why on our end, we really want to have a really loyal base of investors who, when we release a deal, we're not chasing the highest return. We're chasing the best deal possible with the best fundamentals that will stand any market. And I think moving forward, that's a big reason as to why we're, I think agency truthers, where we want to do fixed rate debt moving forward, hold the deals for longer, get rich slow, not, chase the grand slams, but it doubles every single time we buy a property, and, really kind of follow suit there, have good cash on cash, healthy returns, and have everyone sleep well at night.
Yeah, I couldn't agree more. I wish we would have latched onto this strategy earlier, but I think at least, I'm grateful that we're adjusting and getting smarter every day. I think this will serve us well over the long term. We have a few good role models to model ourselves for, for this type of strategy. There'll be plenty of opportunity to make lots of money with this strategy. It's not like, oh, well, sorry, we're just going to be slow pokes and, have very low returns, right? There's still great opportunity to make strong returns. It's just with the added benefit of being able to sleep at night, which I think that is really, really valuable.
Yeah, no, downside protection is the name of the game. And I think you told me this a long time ago. I didn't really know what it meant entirely. Obviously, you know what it means, but when it happens in real time and you're kind of unpacking it and thinking about it more, it's just that investors are blind to risk a lot of the times. So, and it's our job to educate them. It's our job to tell them why our deal is more competitive and offers other amenities other than just the IRR return, which is, safety in the deal and, really proper execution and management of business plan and, our property management team to make that all flow well and keep everyone happy and keep, investor returns and cash flow coming. So good stuff there. And you mentioned Houston. Houston's a really interesting market right now. Everywhere across the board, things are getting more expensive. Okay, so if you're building, more expensive, materials more expensive, labor only going up, inflation's really kicking everyone in the butt. Houston, on top of all those factors going on, being it on the water, has other issues. That's insurance. How much is insurance really affecting the deals? Because we look for deals that are not in flood zones. We really go out every way to make sure we don't want to be in the water anymore. We're really kind of switching our strategy to Houston, that if we are going to buy there, it's got to make a ton of sense with all the momentum we've got going on in Dallas, just to compare and contrast the option of maybe a new emerging market that we're going to be looking in as well. But the interesting thing in Houston is insurance. Insurance is becoming a really big problem there. And I think the logical step moving forward is for the government to intervene or to have it be subsidized one way or another, because way too many people live there. And, we need real estate folks to buy there to improve it and to manage and maintain everything. But with that said, I mean, what is going on that front? Where are the shortcomings coming in? And do you think that is something where that is slowing down the market due to what buyers are looking at when they size up the deal and they do their underwriting and they're getting their quotes back looking like, what the heck? Because we fortunately have an umbrella policy where we get a bit of a discount, as opposed to just the general operator out there that is looking to buy their first deal in that submarket.
Yeah, insurance is a big problem in Houston. We're hearing renewal policies going up, insurance going up anywhere from 50 to 100%. So really huge jumps in insurance. Like you said, we have a master policy, which is going to keep us on the lower end of that range, but still a very big jump. So it's painful. So yeah, like you said, I don't know where the relief is going to come from, whether it's from new entrants into the market to make the insurance market more competitive or some sort of government intervention, but it's very tough. And that has added to the problems in Houston as far as pricing and transaction activity. Like if a buyer is looking to buy a property in Houston right now, they may not know exactly where their insurance is going to come in at, but if they know, oh, it's going to be somewhere between, let's say, $1,200 and $1,800 per unit. And see, the thing is, there's just not a ton of clarity. So you don't really know where it's going to come in. Is it going to be $1,000 a door, or is it going to be $2,000 per unit for insurance? As a buyer, it kind of forces you to underwrite to the higher end of the range, which makes your pricing less competitive. And then the seller's not going to understand or not going to be very happy with that bid. And that's going to keep the bid-ask gap between buyers and sellers wide, to the point where you don't see deals get done.
Yeah, and that's a tough thing going on for anyone who's in the brokerage business out there or trying to syndicate, or us at some point we look to exit the deals, is how are we going to look at that and how's that going to shake out? So there is some downside there, but it's interesting because we do get really great deal flow in Houston, deals that do make sometimes more sense than the Dallas deals. When we look at the numbers, the rents are not too far apart, but there's just the underlying issues with the submarket that make it challenging and make a lot of folks in the syndication space and just in the investment space want to kind of run away from there. We like it, obviously. We've had great momentum and success there, but it is something to think about as we, shift and move around through our experience as operators.
Yeah, I mean, Houston is still a fantastic market, still has tremendous job growth and population growth. That's not going away. So performance on our assets remains strong. And not to say that revenue growth will completely solve all the expense and interest rate issues. That's not the case, of course, but it is very helpful, right? You would be in a much worse situation if you were experiencing flat or declining revenue at the same time as your expenses are going up. At the same time, interest rates are going up. That would be a big recipe for disaster. So that's the reason why we buy in growth areas, because growth solves a lot of problems. And the thing that you mentioned also is the numbers do make more sense in Houston than Dallas. There's no free lunch, right? There's reasons for that. But Dallas is like we said, it's a premier market. And so with that comes premier pricing. There's so many bidders, it bids the prices up and it makes the pricing very competitive. So if you want to, quote, conservatively underwrite a deal and have it show an 18% IRR, that's just not going to happen in Dallas. There's something wrong with that picture. There's no reason why you would be able to buy a deal with that high of return in Dallas. It's just not possible because there's other bidders in the market who are willing to undercut that return, right? And accept a lower return. Meanwhile, in Houston, there's a little bit less competition for those reasons that you mentioned, right? Some buyers just shy away from the weather risks. Some shy away from the supposed dependency on oil and gas and things like that. So that's why you'll see numbers that are a little more rational in Houston versus Dallas.
Interesting. And you mentioned back a bit, and I just want to go back to this. I wrote this down, that insurance is going up 50% to 100% in some places. So how long would that pricing be there for? And is that number going to go up again another 10% in a year from now too? Or what does kind of insurance look like? Because that's pretty aggressive to go up, 50% to 100% in a very short period of time. That's not really mirroring, even though we've seen crazy inflation and things only become more expensive. That's not really mirroring the pace that that's going at, which is a very bad sign.
Yeah, nobody knows. No, insurance is a tough thing right now, and it's not just Houston; it's in Dallas as well. Texas insurance has been very challenged. There's been a lot of weather events recently. There's been people exiting the business. There's been insurance carriers exiting the business and consolidation and things like that, which have made pricing less competitive. So all across Texas, you're seeing insurance go way up and be a big challenge. And so how long will that continue? I don't know. I don't know.
I believe property taxes are something that the mayor or the governor, excuse me, wants to address and slightly go down. Maybe there's a chance that they will also kind of subsidize a bit more of the insurance costs to make it economically more viable, because it is a very pro-business state that wants growth and whatnot. And it's hard to have growth when numbers are not very compelling. So hopefully there can be a solution that fits all parties, where folks like us can benefit and, everyone can provide a better product.
Yeah, who knows? Yeah, the taxes are also a big factor in Texas. They're a very big expense. And it does seem like there's some relief coming to taxes. Not a huge reduction in taxes, but there looks to be some reduction there coming. So that is definitely going to help with the numbers.
Absolutely. Well, we broke down the word of the street for Houston and Dallas. Is there any final thoughts or any quotes that you have in your head that you might want to share prior to or before we transition into the next subject?
Well, I think the moral is there's some deals in the market right now. We're looking at everything. We're putting out bids. We're being more conservative right now because we think that there's going to be better opportunities and potentially 6 months, more likely a year, in my opinion. So call it the middle of 2024. I think there'll be a lot of exciting things to do. With that being said, there's a lot of groups like us that are kind of not necessarily sitting on the sidelines waiting, but are prepared to deploy capital. So that's going to prevent there to be huge discounts in price and a huge buying opportunity. So with that in mind, I don't think it's valuable to just take the year off. I still think there are some deals to buy even today. And so that's what we're looking to do, right? We're not looking to be super aggressive and buy everything in sight, but I think there is still a good opportunity. There are still good opportunities out there.
I agree with that. Awesome. Well, transitioning to a subject that really got you, this got you really riled up.
I thought we were going to talk about Azul first.
Well, would you prefer that? Or do you want to end up getting fired up and taking over the world? Where would you like to go? There's two subjects that we want to talk on next. Both really fun for us to speak about.
Let's liven up the mood a little bit with the Azul closing, and then we'll
Okay, yes.
go to the dark side.
Okay, very good. So Lone Star Capital closed the second deal of the year, which we're very thrilled about. Azul in Houston. Story narrative is, I think, for a lot of people really important, and this one checked both those boxes. Plus the numbers obviously penciled out, otherwise we couldn't buy it, but we're thrilled about this deal. A little smaller of a deal than we would usually buy. I think we discuss this all the time. We like stuff that is kind of in that 150 plus unit for, efficiency's sake, but there are rare instances, very rare situations where we will in fact bend our own rules if the deal makes so much sense. And we did find one that did make that much sense. With that said, I'll let you break it down even further.
Yeah. So Azul is a beautiful 90 unit deal that was built in 2020 directly next door to a property that we own, Park at Champion Forest. So that's what attracted us to the deal. And when the brokers were engaged by the seller to sell the property, real estate brokerage 101, who owns the deal next door, right? Lone Star Capital. So it was a quick one phone call to Lone Star. Hey, this deal is going to be for sale. Do you guys want it? Yes, we want it. Okay, good. And it took some back and forth just because this wasn't a top priority for the seller. He was busy. And so we kind of stayed on and just hounded. Hey, what's going on with our offer? Let's strike a deal. And fortunately, it eventually came through, and we were able to get it for a fantastic price, in our opinion.
What was the going in cap rate?
I want to say it was about 5.4%. Let me just pull up the numbers really quick. So 5.6 going in cap. We locked the rate at 5.6, I think, or 5.59.
So basically at par, just slightly positive leverage, which is incredible for a 2020 build. So absolutely nuts that are the second owners of this, in conjunction to the fact that it's right next door to a property that we manage. And really cool to piggyback off that on the owner's side. Really nice gentleman. Rob and I both met him, but he was just not a multifamily owner operator individual. He's a convenience store. That's where he's made a lot of his money, developing those gas stations, things of that nature. So that was really more of his forte. And he built these units and kind of realized that I don't think his family really wanted any part to do with kind of managing that side of the business, and not to get in it too personally, but the family wasn't really interested in doing that. So an amazing situation for Lone Star here to buy a deal that, fit well into her portfolio. You think about economies of scales and efficiencies. I mean, right next door makes it really easy for us to manage the properties when we go show investors, or if we go to the area, just being able to pop over to see what's going on with it is great.
Yeah. And something also unique about the deal that's really cool is it's the first deal uniquely that we did entirely with 1031 exchange investors.
I'm gonna get into that. Yeah. Awesome. So, yeah, we had 5 investors on this deal, 5 groups, or I believe one of our partners brought 2 investors, but 5 basically investors only. So not too many chefs in the kitchen there, and all 1031 money, to your point, which is just really fun. It makes it easier for you and I, not for Josh, Kent, and kind of the back end team there, the behind the profile scenes team, but really fun to have it done that way. It's funny. We're definitely have had a lot of hand holding and management on other deals. and then this deal kind of closes, and it's been so drama free in relation to the other situations that we're kind of going through right now on our other offerings that we're looking to raise for. So it's always nice when you get a deal done and a low maintenance deal done too. There was also a bit of hair on this one, which is interesting, that kind of shows our expertise and helped us make a deal, and that was the easement associated with this deal. And you actually dove into this on your LinkedIn video, which is a phenomenal video, by the way. And if you don't follow Rob on LinkedIn, follow him on LinkedIn and add him. I'm sure you do, though. But there was an easement situation with how the property sat in relation to the convenience store that he also owned. Do you want to dive into kind of the nuances and kind of the fine print on that?
Yeah, it might be a little bit easier to visualize if people watch the video that you and I recorded when we were on site, but essentially the way that the property lines were drawn, it was kind of awkward. The way that I think there was maybe 8 parking spaces or something like that, that were, yeah, it was like 4 of them or 8 of them were technically the multifamily's parking spaces, but they were fenced in such a way that they were actually on the gas station side. And then conversely, there were 8 parking spaces that were on the gas station's side of things, but they were carved out and lined for the multifamily. So instead of moving the fence line and actually doing anything with the physical real estate or redrawing survey lines, we simply did an easement where we swapped those spaces where, okay, well, we get perpetual use of these spaces, even though they're not ours. And then the gas station owner gets the spaces that are technically on our side of the property. So that easement was a simple swap, really easy. And then the other thing that was an interesting nuance was the retention pond that is on the multifamily side. And so there's an easement so that the gas station has access to that, as well as a co-management agreement that we did for maintenance of the retention pond. And so we're kind of basically, we will do the work, right? We'll cover the costs of the maintenance, and then we just bill back the gas station owner on a square footage pro rata basis.
And then there was also a bit of utility easement, I believe, as well behind the gas station. So we could use some trash spaces too. So this is just kind of the fine print stuff that goes into a deal. You don't think about this. This is not the sexy glamour side of real estate. This is where the lawyer hats come in. And this is why Kent's so incredible and our team in place to kind of handle these little details, because they are really important. They don't sound sexy or fun, but these are the fine print things that may come back to bite you. So incredibly happy to have that squared away and to challenge ourselves just a little bit on that front, but not have it overtake our lives during the process.
Yeah. So smoothest closing that I think we've ever had, but getting to closing was not smooth because, like we said, seller, great guy, but not very sophisticated. The way that they were managing their accounting, their books and everything made it difficult.
T12 was, not the most formal. Maybe you could put it, not the most robust, or I guess institutional, you could say, with, totally understand. We all run different businesses. But it was not the, what you normally would see or get if, let's say, a big shop like us or a larger one would be selling something.
So that made financing more difficult. That dragged things out and delayed things. It was a little bit like pulling teeth a bit, but yeah, once we got to closing, very smooth. Everything was great. But I think this highlighted something for us, which we already kind of knew, but we were willing to bend, which was small deals like this can be more of a headache. And okay, well, will you endure a headache for 100 million? Of course, right? But what about a $12 million deal like this? Well, probably, but not ideally, and not especially not if it's next door and super easy to manage and all that good stuff. So this reaffirmed for us that we definitely want to be focusing on bigger deals, and that's the goal. I think right now we're in a unique environment where the ability to raise capital is it's more difficult to raise capital today, and also leverage is down. So there's more equity required to buy the same deal. So with those factors at play, it makes more sense for us to be willing to do smaller deals. So I would say, and this is what we were telling brokers on our trip, we normally prefer to be looking at deals that are 25 to 50 million in size, but today it's more like 15 to 30 million given the constraints in the market.
Yeah, absolutely. And we raised $5.5 million for this deal, as we mentioned, all 1031 exchange. But to that point, uh, it's interesting because on my end, it's a little less work, of course, to go through the process of raising, 5.5. That's what kind of we do in tandem together. For just as a reminder for the folks who are listening and watching, is that, we're on the equity side, makes my life a little bit easier. But on the admin side, on kind of the back end part, to do $100 million deal is likely the same amount of effort as to do a $10 million deal. So from a company perspective, it's incredibly inefficient to, do smaller deals, to Rob's point. So obviously we all want to do big deals, but most importantly, we want to do deals that make sense and stuff our investors' pockets. So that's first and foremost. But on our end, this deal was below what we normally want to do, but there are exceptions to the rules. We broker rules for this a great deal, and we're really excited for it. So just kind of a little inside baseball there as to how that shakes out and whatnot.
Yeah, it's a really good point. Pretty much the only thing that changes from a $10 million deal to a $100 million deal is our job to raise a little bit more equity.
How much am I calling people? How much am I triple, quadruple emailing you, texting, calling, doing all the things necessary to get it done? So yeah, it is, it's more work for me, but I'll take it all day long because, of course, the other end of it is quite sweet. So
while we know that people love us and they love working with us, we also recognize they probably don't wake up every morning thinking, oh gosh, I really want to invest with Lone Star today. I'd really hope that Craig gives me a call and walks me through the deal and I get to invest, right? That's not top of mind, right? They're busy people, they're successful people.
There's some people that just love hearing my voice and love hearing me talking about deals, Rob. Come on.
Maybe there's a couple, but that's why we are, politely persistent, and we're, making sure that we stay top of mind.
Absolutely. And, we've discussed this, and I think another episode, we'll talk about kind of what we're going to endure, what we saw during H1, the first half of the year, and what we'll see during H2 and maybe the next 12 to 18 months. But that is a great episode, another day for another time. But any other thoughts on Azul? Or I'll just say this, kind of the business plan on it. Obviously 2020, not much is wrong with it. So I think what we're going to do is put some stainless steel appliances in there. That was one request that the tenants had asked for to upgrade. So kind of moving out of, what the black and white Whirlpool looking fridge, give those amenities a little bit better of a space. And then there's essentially no amenities on the property. So we're going to add some fun things there to, have the best quality tenants and have everyone like to stay there, and I believe signage as well. So those are just some small things. It's not as if we have to overhaul the entire property, but a couple of items that we want to add to it to really spruce up the value of it and give everyone the best experience. Did you have anything to add to the business plan as well?
Yeah, I think even though we're buying at a grade in place cap, there is still room to push the rents and bring some professional management to bear. Excitingly, we're also adding a swimming pool, so I think that's going to be pretty interesting for the property and level it up a little bit. So yeah, it's a clean deal, obviously, given it's basically brand new. So yeah, not a turnaround plan of any kind.
Yeah, there's no heavy lift here. That's not like we're buying a place with 75% occupancy and there's multiple gangs inside of the the
hold up and down units.
Exactly. Yeah, there's none of that, which is great. And we're really not in the business of wanting to do that unless we're going to get paid handsomely, but not in this market, at least. Right. So cool. Any closing thoughts on the exciting part of today's show, which is closing talk?
No, that's pretty much it. Just exciting to get a deal closed. I'm always super grateful to get to a closing.
Every deal done in this market feels like 2.5 deals in what we experienced before. So always am appreciative for the brokers who gave us the opportunity, because it starts with them, for the amazing team, Brad and Rob, who underwrote the deal and put the plans together, Josh, Aaron, and Kent, who kind of worked on the admin side, the behind the scenes, the management, and then most importantly finally to the investors who said yes to it, There's a lot of competition right now in the marketplace. We're just always grateful for anyone who decides to give us their hard-earned money. We want your money to work twice as hard as you've worked. So just for all of that together, a sincere thank you to everyone who's associated with the deal. It does mean the world to us. Doing deals is really, what gets us passionate, gives us juice. We're going to be the guys when we're 70 and 80 that will never want to retire. Sorry, wives. We're going to always be working because the juice of the deal is too great. So to everyone associated, thank you.
Amazing. Love it.
Cool. All right. Do you want to have a sip of your water again, or maybe a sip of whiskey? Because I know there's some in your office for the next subject coming up, which is a little interesting. So let's get into it. Do you want to start?
Sure. Yeah. So let me start. So when I was in Houston still, so earlier last week, I read an article that came out talking about a potential fraud that occurred in our industry. So at the time, one of these deals was the largest ever fundraise on CrowdStreet. And so $63 million were raised across these two deals by Nightingale Properties, which I believe is a New York-based office-focused owner-operator that owned a bunch of property in New York, and they were doing an Atlanta business center office as well as Miami. So unfortunately for the investors in the deal, it appears that these two properties in question were never purchased by the venture. And instead, all $63 million have been allegedly misappropriated and have been sent to
63 of equity.
$63 million of investor equity has been misappropriated and potentially sent to personal and business accounts of the head of Nightingale Properties. So basically, Nightingale Properties simply stole money from investors. The purpose of those funds was to acquire these properties. Those properties were never acquired. And this is obviously a tragedy. And, hopefully the investors can get their money back. And hopefully there can be some positive resolution here. But it's very sad to see. So that's kind of the setup. And now there's a couple things to peel back and kind of things to share further. So
real quick, allegedly,
yeah.
Allegedly $63 million were misappropriated and went poof, goodbye. There was supposed to be deals that were purchased that were never purchased. $63 million raised, and this just happened how long ago? Let's see if we have the facts or the alleged facts right. The monies was raised how long ago, and when did we know it went missing?
The money was raised about a year ago, and then investors were notified on July 12 about the potential, about the fact that these funds have been misappropriated.
So I guess the question goes, and I'm just like now in like my CIS and maybe watching Criminal Minds brain. How do they, or like American Greed, right? For the CNBC fans, how do you forge those documents? How does it even work? Because I've seen kind of on our data room and whatnot, which is very robust. And if you want to audit us, LSCDD.com is where you can find it. Everything's fully transparent, unlike some people. But how do you even do that? How do you tamper with documents like that? I guess is my question to you. Is you would know more intimately than myself, as would Kent, being on the operations side more so than me personally.
Well, it's a good question. I don't obviously have the answer. We don't know what went on behind the scenes, but I don't think that's really the important part of this, right? It's because the reality is that when there's a will, there's a way. And I think the important part of that is it's actually probably easier than you would think, because when you're syndicating funds, you're not showing every little detail to investors. They're not waiting to fund to the title company, and then there's going to get confirmations of certain closings and all this stuff, right? That's just not really the standard practice. So unfortunately, it is probably easier than what most people would think to effectively steal from investors. And this is a alleged fraud. I don't want to keep having to say alleged, whatever. Who knows what really happened, but we're just going to use these as an example. But stealing millions like this, okay, this is a big fraud. This is a big deal. But what about just a little bit? What about
pennies?
What about a
Like,
couple grand here and there from
yeah,
the
like an
operating
office
account?
space. Yeah.
What about billing your 5-star hotel when you quote unquote visit the property and you just charge the property for that? Oh, it's just a travel expense. Oh, it's just on the P&L. It's right there in plain sight. It's on the P&L. Well, in my opinion, that's stealing from investors. So there's small scale and there's big scale. This is obviously big scale, which blows this whole thing open. So yeah, I certainly don't know how they did it, but I know that when there's a will, there's a way. And speaking of when there's a will, there's a way. Well, before we get into what gets me the most fired up, I want to also share the other red flag about this deal, which actually was brought up by investors at the time of the fundraising, was the fact that Nightingale was omitting certain deals from their track record. So when they were sharing this deal to the world, they said, "Hey, we're buying these deals. Here's our amazing track record and why you should invest with us in these deals." And that track record showed great deal, home run, home run. And it conveniently left out the handful of deals that they had been foreclosed on and lost significant investor money. So, of course, if investors saw the full scope of the track record, it would have given them the opportunity to maybe do further due diligence and ask about those poor deals and maybe elect to not invest, right? And so I think this opens up a broader topic of track record, right? Yes, it's good to be perfect, but I also don't think it's the end of the world if you do have a bad deal in your track record, because it's an opportunity for investor to ask you as the sponsor, "Hey, what happened to this deal? What lessons did you learn from this deal?" Right? How are you doing things differently to ensure that something like this doesn't happen again? So I think
Pain's a great teacher, isn't it?
it really
Pain,
is.
making mistakes and having to own it and overcome it and call your investors about something going wrong will teach you a lot more than when something goes right.
So the investors repeatedly asked Nightingale to update the document to accurately reflect the other deals, and they just wouldn't. And then finally, this is just how bad it was. Like, if you as an investor were following this and you didn't think this was a red flag, then people were missing something big here. I'm sure plenty of people pointed it out as red flag. The Wall Street Journal even published an article a year ago about this fundraising, and they said, "Oh, there are red flags here." So it made it all the way to the Wall Street Journal. But the red flag was they were repeatedly asked to update the track record. They didn't. Then when they finally did update the track record for those bad deals that went wrong, for the IRR, they just put NA, not applicable. How do you have a not applicable IRR, right?
It's like there's all of a sudden there's not a number associated with the IRR.
Just because it's negative doesn't mean it's not applicable, right?
I
That's
think it's
very
actually highly
applicable.
applicable. It's like I couldn't think of anything more applicable to the situation and the subject matter than the fact that, hey, I actually want to know how this did because I need to audit the best as well as the worst and figure out maybe what's the average. Is the average a 6 IRR over your 30-year decade because you've done terribly? Is it a 15? Is it a 12? Whatever the number may be, that's a very relevant and important number associated. If you look at Lone Star Capital, for instance, we have a 30% net IRR, of course, but we're different, but we've only gone full cycle on 2 deals. Maybe things will change in 5 years when we unload the entire portfolio of $350 million of assets under management currently. That will all change, but investors have the right to know. And maybe because we're, on the younger end of the spectrum, we have to be overly transparent. I have a baby face. I'm 29. You're 26. But the fact that people can get business while being shady, without being literally crooks, is more opportunity for folks like ourselves. It just will take time, of course, but imagine what will happen when we're in this business for 30 years and I'm not looking this young and I have little ones running around. Potentially how much easier the game can be should you play the game correctly over the course of several decades. So that's maybe a positive silver lining there, I suppose.
Yeah. So that's one point. The fraud on the omissions from the track record, right? That's just a red flag, and that was no good to see. But here's the part that gets me fired up.
And this is an overall, I want to preface this. This is an overall thought that you've shared for some time now. This is something that just comes up a lot. This is something that Hunter Thompson, is on our side about the great and wise and powerful Hunter Thompson, who hopefully will be a guest on our show at some point. But talks about kind of this sometimes potentially silly nature to this, but this is a very interesting premise that you feel very strongly about. So let it all out.
So one of the frauds, if you can call it that, about this deal also was that the sponsor, as part of the deal, had promised to co-invest $8.5 million. So there was an alleged $8.5 million co-invest. And so for those that aren't as familiar, a co-invest is basically how much the sponsor is investing with the investors into the deal. Another way of saying this is how much of their own cooking are they eating, right? And the idea is if a sponsor is investing a lot into the deal, that can give investors more confidence and comfort that the deal is a good deal, because if the sponsor is going all in, well, they're the ones doing the deal. They're the ones behind the scenes. That means it's a good deal.
And these platforms supposedly do a lot better when the the sponsor puts a minimum of 5% in, but ideally 10% of the equity in. And that's, just so everyone's clear, excluding the fees associated with, let's say if Lone Star does a deal and there's a $2 million fee and we put $2 million in, that's not the equity for the co-invest that we're speaking on.
Their
The equity
threshold, yeah.
Exactly. That is separate to the monies that you're bringing in from the fees associated with the deal. This is, monies if you maybe 1031 exchanged it and you're rolling your sponsor in, or if you're Richie Rich and you have capital that you're putting into the deal. So,
yeah. So, I mean, I think we can kind of fully break all this down. I might go off into different tangents because there is actually a lot about this topic, but that's the idea of a co-invest, right? The more co-invest, the better for investors. So, but you also jumped ahead to the idea that some investors or some investment firms have a minimum requirement for the co-invest. And so this has caused a perverse incentive in the industry to lie about your co-invest, because sponsors know that they need to claim a certain minimum co-investment to get the approval of the investment firm to invest in the deal. So just like this situation, oh, I promised to invest $8.5 million into the deal. Never mind, I'm just going to steal all the money, right? So this is very frustrating, because if you are of the type of person to go through the hoops to lie about an $8.5 million co-invest, does that also put you on the spectrum towards being potentially the type of person to actually embezzle funds and steal from investors? Maybe, right? If you're so honest, and I know that I'm turning this into a little bit of a talking up our own book and saying good things about us, but that's why
we're allowed to on this show.
We're allowed to. It's our show. But that's why I'm fired up, because we're the honest guys who we've had firms say, hey, we love you guys. We love this deal. Can you invest a $1.5 million of your own money into the deal? And I say, frankly, no, that's absolutely unrealistic for us and would be irresponsible of us to do. And they go, well, sorry, in that case, we cannot proceed. So we've lost equity. We've lost out on deals because of our unwillingness to, one, make the co-invest, and two, lie about it. But here, like, we have an example in plain sight of someone lying about it and then bad things happening. So I think it creates a perverse incentive for investment firms to end up investing with groups that are lying. And here's the result. One result. I'm not saying everybody who lies about co-invest is a bad sponsor and is going to have bad things happen. That's certainly not the case. But that was frustrating to me, because in all seriousness, I know this is kind of tongue in cheek, but in all seriousness, these investors, there was like over 600 of them, maybe 700, that are potentially going to lose this $63 million. They could have invested with us. They could have invested with somebody who's honest, who's transparent, reports on everything every month. I mean, we care so much.
Calls you all the time and texts you.
We bug you and call you all the time.
I will do anything to keep our clients happy, as you know, anything.
I know. And so it's frustrating to see that we're losing business to quote unquote competitors like this for reasons that I think are not valid. I think this opens up the broader conversation or debate about the validity of requiring a minimum co-invest and what's feasible, right? Because as we've discussed, and as you mentioned, Hunter's position, and there's other people, mentors of mine, that take this position as well. As a sponsor, as a growing sponsor, for you to invest, 100,000, 500,000 into a deal, those funds could be better spent as reserves at the firm level could be better spent in hiring new people to have a more robust infrastructure to create
Give the investor
redundancies,
a better experience.
to give the investor a better experience. Exactly. So, and the reality is, this is Hunter's argument. We're entrepreneurs. And so entrepreneurs aren't looking for a 15% IRR on their capital. They're looking for a 100% IRR on their capital, right? Because that's the risk adjusted return that you need to demand as an entrepreneur, right? An entrepreneur takes so much risk that they need to be well compensated for that risk.
Yeah,
so
a dollar needs to create another dollar.
Big time, big time. So those are some of the counter arguments towards co-invest. Obviously, co-invest is very important, and we want to be able to invest with our investors as much as possible, right, alongside them. But this is just a tragic story, an example, and kind of, and that's why I'm always really appreciative of our investors that understand our situation. It's like, hey, we can show you our personal financial statements. We can open up all the books, and we can show you that me personally investing $1 million, it's just not going to happen. And if I had $1 million in my bank account today, I wouldn't invest all my money into one deal. Is this the only deal I'm doing all year? No. So it's a bit ridiculous. And I just, it got me fired up when I saw this. So I will be writing an article about this, and you'll be seeing it in our newsletter.
In full transparency, you don't have to say it. If you want to say it, you can. But I have about a third of my personal net worth tied up into Lone Star deals, which is a lot. I have my house, I have stocks and other things of that nature, and then I have these multifamily deals. So I put my money where my mouth is. I am investing in every single deal, and I partake in the upside in every single deal as well. So every single deal that we do, I am 100% incentivized in, and every single deal could really enhance my net worth that much more. So we have every reason to make these things right. There's just a certain threshold and ratio where if I, as a 29-year-old, have 100% of my net worth tied into multifamily Texas deals, that might be fiscally wildly irresponsible, just for the record. I want to invest a lot in these deals, but just generally speaking, my dad, who's a Morgan Stanley financial advisor, would
He'll disown you.
Yeah, he already is halfway there from not investing enough in my IRA, my 401k, things of that nature. I told him I'm a real estate guy, but he's kind of laid off me just a little bit. But it just does not make fundamental sense for me to, at some point it'll be more disproportionate as things go on. And I do want it to be that way. But at a certain threshold, it doesn't make sense. But it's just kind of interesting, that perspective there.
Yeah. Yeah. So I think that pretty much covers this Nightingale controversy.
So two things actually, because I'm not done with it. Where does what happened? And this is kind of some juicy pieces. What the heck happened to the folks whom embezzled the money or allegedly embezzled the money and went away? And where does CrowdStreet go? Because CrowdStreet, I don't want to make it all negative about them. There are some incredible people we've had the connection or had the opportunity to work with. So our thoughts are with them. We're all going through tougher times right now, but we would love to have the opportunity to work with them, assuming that they're still around in the future. They're great people. We love you guys, and we're thinking about you. But where do they go from here, and what the heck is going on with the sponsor that took the money?
I have no idea. I have no idea where the sponsor went. However, the article also references, I think, maybe 5 or so foreclosures that have recently occurred or are in progress in New York. So the sponsor, Nightingale, has properties here in the city that have been foreclosed on, and they're losing a ton of money. And so one of these deals even is 111 Wall Street office building. And I believe, I could pull the article up, but I believe that one's being foreclosed on right now, or it's just under heavy pressure, vacancies, all that. And they just did a $320 million renovation on the property. So we're talking big numbers, we're talking big losses. So my guess is that the $63 million that was allegedly stolen from these syndication investors, I think they were embezzled to cover losses and support other distressed properties in the Nightingale portfolio. And so I don't think this was
a Ponzi scheme.
Well, yeah, but for sure. It's illegal on many levels, but I don't think it was necessarily intentional the whole time to steal. I think it was basically an act of desperation that properties were not going they're going south in the portfolio, and they're saying, "Oh shoot, I mean, we're under real big stress. Well, let's just take the money here in this account, 63 million. Let's just go and use it for something else." I think that's how this probably all happened, and that money is gone. I think, right, because that money was put towards deals. There's good money after bad, and now those deals have been foreclosed on. So, there's possibility that there will be some recourse at the firm level and at the personal level for to retrieve this 63 million back. But is there going to be any value and equity that's able to be extracted from Nightingale, right? Or are they totally upside down on all their portfolio?
So who covers the misappropriation of the funds? Is that a platform situation where they have to repay them? Or are those investors who elected to go with the deal? I don't know the fine print and the legal docs of working through a platform like that, but are they just SOL for lack of a better term?
I think so. I'm CrowdStreet is very smart, and at the end of the day, they're a broker dealer. So I'm sure in their documents as a broker dealer, right, they're not taking responsibility here. They take responsibility as a broker dealer to provide necessary disclosures and risk factors and things like that. But definitely, I couldn't imagine there being any legitimate lawsuit against CrowdStreet. So I think this is a problem with the sponsor. I'm sure there's going to be lawsuits flying around. There's going to be a lot of problems, but I think CrowdStreet's going to be fine. I think they are going to move on from this and be fine.
Good. Well, I don't want to see, even if you're the biggest competitor to us in Houston or in Dallas or anywhere, anyone lose money, have anyone get stolen. We want to compete and be the best we can be and just focus on ourselves. And, if there's other people that are successful, we're just want to be sponges and, learn from the best and be the best. So we hope that, everyone is okay associated with this and it all gets solved. And if you have any information, feel free to reach out to Rob and I. We'd love to, offline, of course.
We'd love to gossip.
Exactly. Yeah. We love the insider talk there. But no, in all seriousness, our thoughts do go out to the good people of CrowdStreet because they are awesome. And hopefully we can get on our platform and figure out a way to make a co-invest and work. And for all those investors who are looking for, someone to not steal your money and give you healthy returns, as mentioned throughout this podcast, and what we're doing, please think of us. So
I love it.
good. Well, on a lighter note, after we release all that tension, something I want to think about just in generally, and I know you force myself, Dasha, and I think many people in the firm to read this, which is the Pensford letter. But what do you read daily, or what books are you into right now? Just tell us about yourself, maybe your routine, and what you kind of your habits and your checking looks like. Because you're an avid reader. Are you a speed reader technically?
No, I don't even think I think I read pretty slow or just average. I'd guess 200, 250 words per minute.
Okay, gotcha. But what do you read consistently or like you religiously check?
Well, like you mentioned, the Pensford letter is very good. So I like to have everyone read that every Monday as it comes out. It's just good to stay on top of what's going on in the economy, right? There's many ways you can get information to read about the economy, Fed raising rates, all these things. But I think the Pensford letter does a really good job of actually looping in Bloomberg charts and showing you the real data and saying, okay, well, the expectation for the manufacturing index was X, it came in as Y. It's going to have these sorts of repercussions and things like that. So it goes, I think it's a very digestible way to stay very up to date on the news, which is very valuable for our business. So the Pensford letter is great. Other than that, there's not too much that I keep up with. I used to read the Wall Street Journal every day, but it just felt very redundant to me and like I wasn't getting much value there. So there's not too many places that I think where you can follow on the daily basis to get a ton of value. But something that's more periodic is the Real Estate Crowdfunding Review, which is by Ian Ippolito, which is actually the article that I read where I got the news about the Nightingale Properties debacle here that we just discussed. So Ian is a really bright guy, really great conservative investor. We've interviewed him on this podcast a couple years ago. So Ian's super solid, super sharp, and so I always appreciate his articles. And so his Yeah, his article about this Nightingale property situation was very good as well.
Gotcha. Very good. Any final thoughts before we wrap up and close here?
Hmm. I don't know. I mean, I think we covered a decent amount. I'm pretty happy with the
We're an
venting.
hour, yeah, we're an hour and 15 in, by the way, if you didn't know that.
That's perfect timing. I think that's good.
Flows. Cool. Well, as always, if you're looking to learn more about Lone Star Capital, I'm your guy. My email is craig@lscre.com. Once again, Craig, Craig @lscre.com. Always feel free to call, text, email me. I would give Rob's information out, but he's too doesn't do these fun calls like that anymore. So you'll be hearing from me, or if you want to reach out and learn more. We're currently doing some deals right now. We're raising. We actually had a really momentous week last week, which we don't want to get into the details yet to jinx anything, but it was really amazing, and we're thrilled about that.
We'll be able to
Uh,
talk about this and all things at some point.
exactly. So there's just like the real estate market has a 6 month lag. Sometimes the details and little nuances that we would love to share, but we can't yet for obvious reasons. We'll have to wait. But if you have any questions as well, do we have a mailbox now for the show?
Yeah, we do. We
Want to
have
share
a
that?
mailbag at lscre.com.
Yes. So if you have any questions, and maybe at some point we might run out of things to talk about. So if you want to email us any questions as a sponsor that you might be going through, or just anything you want us to cover on and speak on, we will be checking that email avidly. We'd like to get to that and kind of be interactive, and maybe even provide the listeners some value and answers kind of some of your problems as you're talking to one of the best and brightest minds in the game, Rob Beardsley. So we would love to kind of walk through that, and I would love to learn along the way, as I'm sure a lot of you guys will here as well. Excuse me. So yeah, feel free to slide in there with some of your questions. We'd love to get you some answers. I think we'll be together soon, maybe next week in Dallas, or no, 2 weeks from now,
Couple
perhaps
weeks.
in Dallas. And then I'll be in New York for a blood drive. We have a blood drive coming up if you are in New York, at the World Trade Center. So please come by there. Then I'll be going to Nashville for a Biz Now conference. Is that what it is? Correct?
Mm-hmm.
Very good. Then I think I have a month off traveling. Then I'll be in Houston, and I'll be in New York for about a month. So yeah, a lot. We're moving quickly here. So
A lot of good things coming, that's for sure.
yes, blessings on blessings coming up for sure. Well, everyone, thank you so much for paying attention and being here and listening to the Capital Spotlight Show, episode 6.